Okay. Okay, everybody, it's Kevin and Pat. Glad you could join us on our show again here, and we've got a great guest with us today. We've got Hypersonic 78. You can see Hypersonic's Twitter profile there at Hypersonic 78. How you doing? Do you want to introduce yourself and tell everybody where they can find you?
Yes, good morning. Hypersonic 78 handle I go through here. Was on the show, the YouTube a few weeks ago with Pat and Kevin talking about Elliott Wave. So I encourage you to go back and look at that. I won't go through all the inner details of how Elliott Wave works. Basically, five ways up. In the general trend, you've got two counter trends in the middle. ABC formation, three waves down usually in the counter trends. While five in the primary trend. Ralph Nelson Elliott created Elliott Wave in the 30s, and so it's a technical analysis tool that used to kind of, a predictive method of where the markets are going. So been looking at Elliott Wave for several years now, and it can be pretty accurate. Definitely better than 50%, than a coin toss. So, and if you get good at it, it can be as high as 70 or 80%. So, the one drawback for Elliott Wave is timing. It's very difficult to predict timing. It's also subjective. It depends on, the eye for recognizing chart patterns and the wave patterns. All waves themselves are fractal in nature and self-similar in varying degrees of time. So if you zoom out to the big level, you can kind of see the five waves, but then if you zoom back in, over days and weeks, you can kind of see the same patterns pick up. So that's kind of a quick overview of Elliott Wave. So last time, Pat and Kevin, you asked me on to kind of talk about a Substack that I started, which I have pinned to my profile here, talking about what I think is going to be a very interesting time for the markets and society as a whole. I'm calling it the upcoming 21st century stagflationary depression, because a lot of the charts I'm seeing in commodities and equities, it looks like, there's going to be a major correction in the general markets.
Yeah, now this is what we one of the things we sort of reached out to you again to discuss, because myself and Patrick have been using our technical analysis techniques and our weight of evidence gathering techniques to look, obviously at a range of instruments right across all markets, but in particular the stock markets at the moment. And we have focused on the Nasdaq and the SPX to kind of represent, and how sort of capital flows from there into precious metals and other markets are taking place, and how you can spot those capital flows. And for a while now, we've noticed that the S&P and Nasdaq have broken down versus inflation. It's only the fourth time that that's happened since the First World War, in fact. And when I say broken down versus inflation, we use the PPI, all commodities index, to be a proxy for inflation. And when you plot the S&P or Nasdaq versus PPI, it's very clear that we have broken down. And this is kind of the first warning sign, or one of the first warning signals, that something major is happening, something different to just a regular cyclical correction that's going to turn around and go to new all-time highs. So we felt for a while that something different is happening here, and we're starting to see indications from other pieces of evidence now starting to develop that this is something way more serious, if you want to put it that way. So your Elliott Wave count, which clearly you're more expert in than myself and Pat, and we're really keen to hear how you're seeing the Elliott Wave development on the stock markets, and where you think we might be going. Because if it's different to what we're thinking, that's great. That's added evidence that we can put on the other side of the pile to weigh up against the evidence that we're seeing. But if it's also suggesting something along the lines of what we're seeing, then that's another weight of evidence to cause us great concern. So what are you seeing?
Yep. So yeah, that's a very interesting chart, the SPX versus the producer price index. Yeah, I saw that Pat had posted that a couple days ago, and he asked me, "Hey, can you put some Elliott Wave counts on this?" And so I did. Yeah, I wanted to kind of see if there was any kind of wave counts we can come up with for that. And there was the one thing want to say again, 5 major waves up. There's not a lot of data. You're not a little dinosaur down there in TradingView. They don't have data past there. But assuming everything that led up, if you look at the longer term SPX chart and Dow, there is data back there. But all that led up to what I'm assuming was the first cycle, right? And then leading up to the Great Depression. At that point, we had a corrective wave down, hard and fast, wave 2, and then that's about the time where Ralph Nelson Elliott said, all right, there's going to be a major 70+ year bull market in stocks, right? And that was just about the time of World War II. And he said, there's going to be, a rally coming. So one of the better calls, I think, of the century, right? To make that call, just coming out of a Great Depression and the World at War. Quite predictive in my opinion. But again, so we can kind of subdivide, that whole wave, into a cycle, wave 1, 2, and then 1, 2, 3, 4, 5 in the greater cycle. And then, through the thousands, we had the collapse of the dot-com, where we have our A wave down, and then the housing bubble. You can kind of see that inflation, drove a bit of a smaller B there. Correcting down to the depths of the great financial crisis in wave 4. And then what I believe is we have topped. I know when you had me on last time, I thought that we could have gotten another big bounce, like a nominal high that's a little bit higher. And I'll kind of switch now to the main SPX chart. What I showed before, just so the audience is aware. Scrolling down, I thought there would be one more wave up. Okay, so like kind of a deep 4 here, with one more push up potentially to the 5400 level, 5500 level, in that box somewhere. We usually like to use some what I call Fibonacci extensions, to figure out based off the movement in waves 1 and 2 where the markets could potentially top out. Again, you can't get really perfect. You need to start looking at other indicators in the market to get the right top, but at least it gets you in the box, right? It's kind of a pay attention zone, so to speak. So that's what I thought before, but with the market action, you have to be, again, Elliott Wave is subjective, all right? The eye of the analyst, looking at that, looking at all the subdivisions of the waves themselves, on smaller degrees, to come up with the right pattern. You've got to do the work, so to speak, into defining those fib levels and seeing what the wave patterns are. So that said, I'm kind of changed my count that way. I'm quickly getting into the opinion that we saw a truncated 5. So that the top was actually a really smaller 5 in the minor degree, and then that's it. I don't think, there's a potentially that this whole move here could be a big one, but just with the sentiment and looking at, where the market's, how it's reacting very, very correctively, and also in a big degree. That's a really almost too much structure now to call it a 4, right? What's kind of teeing me off right here is or what's kind of changing my opinion is this one right here where I have my first minor degree wave. You can see that now the market over here, there's some overlap, what's called overlap. Like the price is now sunk down below where the peak of 1 was. So that makes the count a little bit less, well, it's more less probable, less certain that that it's impulsive. It's no longer an impulsive move up. It's the likelihood of now impulsively moving up higher is a lot less. I can't give you an exact percentage why, but that's the behavior that you need to recognize. So
that's interesting because it seems that in Elliott Wave, there's a very clear set of rules, and that much I do know, and there's a set of rules for how each wave behaves, and a little bit like the technical analysis weight of evidence techniques that myself and Pat use, being aware of where those levels are does allow you to quickly spot when one scenario becomes more likely than another. I know some people will be watching this and they'll be thinking, 'cause I know they'll, they put it in the comments. Oh, great! So it can go up, it can go down, or it can go sideways. That's kind of missing the point. And if you're thinking that in your head at the moment watching this, then just try to understand that by knowing where these lines in the sand are, where these thresholds are, as a trader and investor, it gives you really valuable information, because it tells you when the odds have changed. If you're betting on a horse race, you want to know the odds. You want to know which horse has the best chance of winning. And by using a technical analysis chart, and we're looking at Elliott Wave here, if you know where these levels are, you know when the odds have shifted against you. And that's important, because you can then change your bet. You can readjust your bet and take advantage of that new information. So try not to be cynical about technical analysis. It's not about certainties. It's never about knowing for 100% which horse is going to win the race. It's about always knowing which horse has the better chance of winning the race, where the odds are at any point in time. So I just wanted to say that.
Exactly. As an Elliotician, you have to constantly look at the structure and adjust your counts. Like right here, is this really a 1-2? I could be off. This 5-wave structure down, which tends to happen in wave C's. It could be a lot more condensed. This move from here to here, this squiggle here to here could have been the 1-2. And then this could have been, the wave 3 right here, 4, 5. And so C could potentially be done, right? We could be moving up into a bounce, right? B waves themselves, a larger degree B wave, like this B over here, it could actually extend up slightly higher. We may not get all the way up to 55 and make that a new high like we thought before, but it could be a significant, rally or bounce, is what some other people like to call it. But I have to adjust, right, and let the market dictate where, the structure, Elliott Wave structure potential can be. So just as you said, you have to adapt. Elliott Wave is just only a tool in your toolbox to make adjustments as you go. Another thing I'm looking at here is the divergence. You see the MACD, moving average convergence divergence. That's another signal I look at. Once we get a bullish cross here, it's called a positive divergence. As the market's going down, this indicator is moving up. So that's an indication that the selling momentum is slowing down. So maybe it's time to relook at the structure and see, is that really the valid, most probabilistic, structure that's playing out.
Is there any? I was just going to say, is there any use of things? I see you've got a sort of a support line and a resistance line there, defining the channel, the overall channel going up from bottom left to top right of the. Would you, for example, draw a resistance line from your 5 down through your red B and your yellow B, and that creates a 3-point resistance line? Would you use that at all to suggest where the upper limit of a move might be? Yeah, that line there.
Yeah, but I usually don't use too many lines like that. I guess you could. I mean, that's another way of drawing it. Remember, this is log scale.
Because the reason I ask is, you're talking about sort of the B might be, you might shift it up to somewhere near 5,000, or we get a rally to the upside, and just knowing whether that is likely or not, or possible or not.
Yeah, what I'm looking for is 5 waves up from a meaningful low. All right, you've got one kind of impulse in impulsive ways. When I say impulse, there's no overlap, right? Wave 4 is not going down lower than where wave 1 is, or wave 1 peaked out. So it's a nice, clean, impulsive structure. And so once we have that, that's kind of a bullish indication. And the very first degree, like usually on the 144-minute scale is what I use, just to kind of gives you enough time frame to see what's happening. So right here, I mean, it's kind of we got a little squiggle here, 1, 2, 3, 4. We don't quite have 5 up though, but we're getting there in that small degree. This could even be considered just, the first part of one wave, but you might want to get up to here, first get kind of a good rally, and then another pullback, 1, 2, and that sets off your whole structure of where the rest of the chart can go, and setting up where Usually the resistance levels between the 618, the 61.8 Fibonacci level and 78.6. That's usually the resistance line in, setting up that, is it going to play out that 5-wave structure? I want to see wave 3 push through that resistance. So just for an example, if I were to use this structure, assuming this was 5 waves up, I could say this is wave 1. Now we pull back to 2, and then let's fix our fibs here: 618 and 786. This is just an example. Don't use these real numbers. But if I said that this was, say, my 1, 2, 3, 4, 5, the resistance line would line up between your 786 and here. So that's what a pivot is. Okay, I want to see things rally through up to wave 3. All right, which usually tends to go up towards the 1.236, 1.382, sometimes as high as the 1.68. Usually a 3 indicates that wave 5 is going to go even higher. But I want to see that play out and then basically hold the line, hold wave 4. And then, of course, we're going to see a higher degree, a 1, 2. And that's when I know that this is a whole entire bullish structure. Avi Gilbert calls it Fibonacci pinball method. So if you really want to get down to like actual day trading, I recommend that's a great site to join. So definitely worth the money if you want to use Elliott Wave in a trading fashion. But again, I'm kind of I have my own style and my own, longer terms that I do. I got a day job and I can't day trade all day. So, but that's a great site to learn how to do that and learn the details of it. But that just kind of shows you like where the resistance line is, in terms of Elliott Wave. So, which that might actually coincide with what you were saying, with drawing that line, so to speak, as that structure fills out. You said that there might be a line here. Well, yeah, once I've gone up to 3, I've held the 4, gone up to 5, that's your breakout. I just did a back test of that little line here. So it kind of does play into some of that traditional technical analysis that you speak of. Does that help?
Yes. Yeah, it does. It's interesting how, sometimes Elliott Wave, expectations do tie in with what we're seeing. And I always like to look at the scenarios and see how that plays into what my own expectations are. And, whenever I've got and I know Pat's the same, and I'm sure you're the same, whenever you're focusing on what is the most likely outcome, you also have in the back of your mind what the alternate scenarios, or in your case, the alternate counts might be, because you need to be aware of that, so that when it starts to trend in that direction, you can switch your wave count, or in our case, rule out one of the scenarios. So from that point of view, it's I find it really interesting. It's all part of the weight of evidence. So taken as a whole, stepping back and looking at the S&P, it's kind of big picture. Whether we do or whether we don't get a bounce up to 4.5, 5,000 or whatever, nominal new highs or not nominal new highs, do you see this as something that is potentially going to result in stocks taking years to recover back to the levels that they were at, or is it your view that this might be something more comparable to or something that's more sort of short pullback and on up to new highs in the next couple of years?
Well, in the next kind of the first one, but we're going to get a bounce. There's going to be this giant B wave, so that could take us to the nominal highs before go even lower. So the B could be a double top, right, where the B heads right back up where we were last year. So before we get a C wave down to this point here, we'll have to kind of see where the fib levels are for that.
There is an interesting thing I'd like to mention at this point, actually, and I don't know, again, just to raise a bit more awareness on this. I know everyone's looking for the pivot talking about the pivot's important. When's the Fed going to start hinting that they're going to ease back on the rate hikes? And everyone seems fixated by it and convinced that when the pivot comes, the markets are going to go, up and up and up and up, and we're going to have new highs. If you actually look at the evidence, you look at the historical evidence, it doesn't. That doesn't really hold true, because if the S&P is below its 3-year moving average historically, and the Fed announces a pivot in the middle of a rate hiking cycle, what happens? Well, you might be surprised. What actually happens is the stock markets tank and go even lower. So what I said before about those 3 previous occasions since the First World War, we've been in this position. This isn't the first time we've been here. We've been below the 3-year moving average. We've been in a rate hiking cycle, and the Fed has pivoted. And what happened? Well, the stock markets went lower and lower and lower. So it's just worth bearing that kind of historical evidence in mind as well.
That could be the catalyst for my C right here. You see how we could just dump down another I guess that's what, 800 points.
Yeah.
Before getting a significant bounce and then going lower. So
historically, when the Fed pivots below the 3-year moving average, S&P below the 3-year moving average in a rate hiking cycle, the result isn't good. And I think it might come as a shock to a lot of people who haven't studied the history of the S&P and how it behaves once it's below the 3-year moving average. So that's something else to bear in mind. Lessons from history can give us some big clues with these things and can help us to probably, I think, weight our wave counts and our scenarios accordingly, and kind of give the appropriate weighting to them.
Exactly. I mean, regardless, we're in for a 7 to 10 year bear market. I mean, it's not
right. Wow.
I mean, it could be as long as 20.
Yeah.
We have to look at the way this A wave forms. Okay, it's going to be corrected, but then we really have to watch what happens, after we bounce wherever this level ends up being. Okay, this corrective, whether if it's what's called a corrective wave, 3 waves up and there's overlap and it's sloshy, that means it's not an impulsive rally. It's not a renewed bull run to new all-time highs. Wave 5 has not started yet. It's just a bear market rally that will last several years.
Yeah.
And then people might be excited because they don't realize, that type of market structure behavior, overlap and lots of messy chart structure means uncertainty. All right. Yeah. Participants aren't certain what's going to happen, and so the price is all over the place. So if we see that during here, then we have one more leg down, before we can call, super cycle wave 4 complete. So I'll have to, again, let the market tell us what happens. I'm not certain that there's going to be a 20-year bear market, but by now, but I know we're in for a larger corrective move here. I mean, if it is, and it is an impulsive move, that means I have to recount this whole structure. Like right here, there's 4, but that means this whole move right here was just like this. It was just a very large intermediate 1 with your 2, and now we're moving back up. Okay, so that means wave 5 is way out here, several years ago. I have to readjust my primary wave 5. Right now, I believe I'm going in with the mindset that it's the end of primary 5 of cycle 5 of super cycle 3, but I'm going to let the market, prove it to me at this corrective, the primary C of what I think is super cycle 4.
So you would say that the probabilities of this being a generational decline in stock markets, which lasts quite possibly a decade, and even plausibly a couple of decades, is those probabilities are significant now.
Right now, that's the primary path. Greater than 50%.
Yeah, I mean, as it happens, I would agree with that. But if your view was different, then that's something that we all sort of factor in. But when analysts from different fields and different backgrounds are starting to see the same thing, it's interesting. I mean, I suppose some contrarians would say, "Oh yeah, everyone's seeing the same thing now, so it's going to do the opposite." But you do need to follow the evidence. And also something to point out is that commodities and precious metals, if you're wondering, or that bounce from C to B that you've got there on the red line, the lower points, well, point A, I suppose it is actually point A to point B on the red line, When you get a bounce in the stock markets like that, in that situation, in that kind of generational stock market decline, that's when commodities and precious metals do incredibly well, actually. So the stock market rallies start to become bullish for particularly mining stocks as well. So
That's a great.
I was, just to sort of get across the point that the relationships change. The way people have kind of become accustomed to market relationships over the last 40 years. This is a change from that. It's a different set of relationships, and the ratios between the stock market and the GDX, for example, they change.
Mm-hmm. That's a good segue into
yes
part 8. So
yeah,
inflationary pressures, right? I mean,
yeah.
I've gone through many different sectors in the stock market. In the first few parts of the Substack, I wanted to look at each sector individually to see if I was seeing some of the same things in the bigger stocks or within that sector. And so part 8, I cover energy, which is a driver of inflation. Right? We use oil for everything. So looking at the oil chart, so yeah, people can go to the Substack and read it. It's out there just to share these. Again, these views are my own. All right. Make sure you do your own diligence, and don't blame me if you place a bad trade. I'm not a financial advisor. I'm just an Elliotician. I've been doing this for several years. I want you to get in early at Wave and learn the techniques yourself. And I just want to help people with what I know, what I see in the markets. But oil itself, I mean, I created this chart for the oil thing, and it's kind of fascinating. It's a 5-wave structure. I'm counting everything before 1862 as you're moving up to cycle 1 before data was taken, right? We still had oil back then. But look there's your A, B, C, for wave 2, and that kicked off a long bull market in oil. We had some steady times here where there wasn't a lot of data taken, but then we got our wave 3 in 1980, and then a very long ABC down to was it 1999, wave 4, and then super cycle wave 5 ended 2008, right? So then we had this long 14-year correction, right? That's a long bear market in oil, just like we had here, but that was like your first grand super cycle, and 2020 price actually went negative. I'm just counting the monthly close for this chart, to kind of draw the channel. But that kicked off a brand new major cycle bull market in oil, right, which is the driver of all energy and inflation. So, and you can kind of see if we, I'll zoom in, to a closer chart here just so we can kind of see it. This is the
grand super cycle. Is there something bigger than grand super cycle? Because that seems pretty. Is that the longest cycles ever?
I think there's a millennial super cycle too.
Jesus.
I don't think TradingView goes back that far.
So 2020 could be the grand super cycle low for that second, for the corrective wave from 1 to 2. So now we're not even talking about this grand super cycle wave 5. Now we're just doing the mid, the bulk, right? The 2 to 3, right? That's what's happening.
No idea how long it'll take either. I put some fibs out there just to based off the 1-2 again, or where we could end up by the end of it. But I mean, we may not even be alive, when that happens. So
crazy, right?
Yeah, I mean, there might be
$1,000 oil. I'm not sure I'd want to be.
Exactly. Well, is oil really going to be priced in dollars at that point? I don't
quite
know.
Possibly not.
Yeah.
No.
Well, I just have to mention, who cares about the nominal value of oil, right?
Yeah.
It's its relationship with the other assets, how how it's stretched from other prices, right? Because oil used to be a quarter a barrel, for crying out loud. And if we would have told them it'd be $100 a barrel, they might have said, I wouldn't want to live in that days. But look, it's not. Look, we're doing pretty. Like, I have a baseball cap, I have a polo shirt. Like, it's not the end of the world right now. It's probably, I don't know. You know what I mean? Over there, like, we don't have horses. Everything's not that bad. So I don't.
It's the proportion.
Yes.
Compared to everything else, it's the relative cost. Relative cost is what's important. So you can add 20 zeros onto it. It doesn't matter if you're adding 20 zeros onto everything else. You're quite right, of course. Yeah.
Exactly. And you can kind of see here, again, 5 waves up and they're impulsive. There's not overlap. It doesn't they don't correct over each other. Like you can kind of see, you know, in this corrective B, you know, it squiggles up and down, not only 3 waves, 1, 2, excuse me, 1, 2, 3, you know, there's not, you know, impulsiveness, you know, where 4 is ending up higher than 1, you know,
okay,
that's
just for me to understand, and maybe people, so corrective waves, ABC patterns, they are impulsive, so they don't, it's clear the line, they don't come back down and to previous support or resistance.
right. Impulsive lines are clear cut ones, and you know,
Okay.
no overlap. Okay. You're seeing 5 clear waves up. Your 4 is not, like if this was a more corrective, we'd just see 3 waves, A, B, C. You know, we wouldn't see 5 waves like this.
Okay.
So that might be, it's just correcting up before going lower, if that makes sense. It's like right here, it's correcting up, A, B, C, and then it's going down, A, B, C, way down to -37. That's corrective waves. Impulsive waves, we're moving up. You know, and C waves themselves, like right here, we can, if we zoom in, I'm assuming this is a C wave, you know, there'd be 5 subwaves inside of this movement too. So they can also present as 3 waves as well. Corrective waves are kind of tricky. There's lots of different patterns. There's, you know, just if you look in TradingView, you know, there's triple combos, double combos. There's different types of corrective waves. You know, you can have running flats where your C equals your A. Right now we're getting a deeper C on oil, but so far this is a corrective type wave, which tells me we're going higher. This is part of a larger degree structure.
I was about to say that. I mean, never mind $1,000 in 40 years time or something. It's I think the rate of change is what's quite important as well. It's the speed at which you get from, you know, a low to a high point there. I mean, if you're talking about a couple of $100 in the next 2, 3, 4 years or something, that's probably, you know, quite enough to be coping with. And I suppose that also is added inflationary pressure, because anything that uses oil in production or transportation, of course, the energy involved, you know, the energy part of the equation there is going to keep a steady sort of upwards, or at least I was going to say an upwards pressure on inflation, but it depends what the other factors in inflation are doing. It's at least going to be a component that kind of is stopping inflation from falling too far.
Mm-hmm.
Which is
Exactly.
interesting. Yeah.
They also bring natural gas has a similar, you know, structure to it as well.
Right.
Of course, natural gas is used quite a bit in producing fertilizers, also used to, you know, for heating and cooling. Just from the data I have going back to 91, this is kind of corrective too, like very sloppy overlapping waves. But it did make, you know, I guess if we were to subsect these, I think that data goes back further. But if we were to subsect it, we would see a 1. But then here's your wave 2, a corrective pattern on the way down, which broke out from a trend line in a 5-wave impulsive pattern, right? Your 4 did not go down lower than, you know, than -1. And so now it's in a corrective type pattern. We'll find support somewhere. I put some Fibonacci retracement levels here, which it hasn't hit the 386. I think it's already past the 236. Let's check that. Should have had that on there. Let's just do. Yeah, see, it's already past the 236. So, I mean, I kind of think natural gas keeps consolidating here and correct. That's one of the harder things to do in Elliott Wave is, you know, I actually asked one of the analysts too on Elliott Wave Trader, hey, is there any statistical data that can tell you like how often one corrective pattern, whether it's a zigzag or a running flat or a standard correction, happens? And he says, yeah, I have no idea. So it's pretty random, you know, since the markets are non-linear. So you have to be very careful with these corrective waves. I mean, they can last, as we've seen in silver, you know, the corrections lasted a long time, like 2 years, you know. So I don't know if this 2 is going to take, you know, out to 23 or it could zip off right now. So you know, if you're trading natural gas or other companies buy it, you have to watch for those levels and really look at the corrective patterns, and also look at the, you know, the divergences. You know, are we, you know, right here on the weekly, it's still looking like it's wanting to come down and consolidate some more. So maybe this is a larger corrective pattern before we start moving up, and then these Fibonacci extension levels that I put out here are just based on, I think I just put them down at 0.5, just as a example. I don't know if it's going to go that high. Once the bottom is confirmed in intermediate 2, we can kind of set those patterns. So again, I can also set up what I showed you before, the 0.618 and the 786. That would be my pivot point at that point, to say, yeah, now, the correction's over. I'm above that resistance pivot line. Now I can go long and start buying, some natural gas related energy stocks. Of course, each chart on its own, you probably don't want to just look at the commodity. You want to look at the individual chart itself if you're looking at that. But yeah, this portends, because we had 5 waves up, a breakout of this, descending wedge. The bottom was put in from 2 in an impulsive fashion. We're heading higher. Natural gas is going to trend higher, which is going to be inflationary for, quite some time.
I'm curious to know, because for the timing issues, can you do Elliott Wave on point and figure charts, on Renko charts, those exotic chart types which condense time, but just show you pure price action?
That's a good question. I don't know the answer to that. So I know for Elliott Wave, you want to really, dig deep into the wave structure as much as you can on tinier scales, on smaller degrees, to build out your larger picture. So you really kind of need to look at. That's why there's where some of the subjectivity comes in. Is this an ABC, or an ABC in here, for me enough for me to call it a 2, right? So I kind of need to see those lines and that structure,
okay,
to identify waves.
So you cannot dismiss the smaller time frames. Everything's built from the smaller time frames, and which builds into the bigger ones. Is that how you generally would approach it? You say, okay, I think I have this big structure, but I have to go zoom in and make sure I have these smaller structures that they build fractally that makes the bigger structure make sense.
Exactly. Yep. And then do the fibs too. Like, I know my wave 3 is going to be somewhere between 1 and 1.5, more often than not between the 1.236 and the 1.382. That's generally where wave 3s. Now they could extend higher. So you kind of have to look at each chart on its own and, see where that fits. Sometimes we can get. Sometimes
I suppose if you did it on a Renko chart, Pat, what you're looking at is the big picture, and you're kind of missing the smaller detail that's embedded within that. So I suppose just thinking about that more carefully, you probably, if you're looking for a trend change, you probably need to do it on a regular chart that shows the full time span, I guess, because that's where your trend change would start, and then it cascades into the higher time frames, doesn't it? So on a Renko chart, you're just looking at the effectively, and a point and figure chart, I suppose, as well, looking at the bigger picture, I think.
Yep. All right. But I think that kind of does it for energy. I also charted uranium because I know you guys are a fan of that. And
uranium. Yeah, we're going to have lots of people wanting to know what you're saying about this.
Yeah, so I drew the arcs here. I'm not sure if they're valid. And I see a different couple of patterns here. This could be like a cup. I mean, the cup kind of struck me just a kind of a standard trading pattern. That this kind of, I like the smile here. So, but again, 5 waves up. We did see 5 waves up in, uranium off the 2020 lows. So that's also bullish. And just like oil, it's following a similar type of corrective path here. Now, is that all where I have my A there? You could kind of see if we zoom in. I could say that this is an A, B, C, and then I'm done. That's all of 2. But look at how much overlap we have here. It's kind of squiggly on its way up. I guess we almost have 5 waves up, but they're overlapping waves. Like this 4 right here. Let's just zoom in. I'm going a little bit tighter here. All right, so you see where if I were to call this a 4, if that was my 3 and this is a 4, my 4 is under where this 1 is. Do you see the overlap?
Yes.
So that means it's kind of corrective. I mean, this might just be, there's less certainty. It could be a 1, so I have to watch for that. And that means, the intermediate bottom is in. But there's less certainty of that because it wasn't impulsive. Does that make sense?
Yeah.
So we have to kind of watch it. Impulsive structures are a little bit more certain. We're also looking at the, I do have some negative divergence here. So this tells me maybe there's a slightly lower low coming. It could be a running flat where C, it goes back to the same level it was at A, or slightly lower. Maybe I get to $11 before, we're off to the races. So, but I am watching uranium. I do want to have some positions, ready to go for this wave 3, which would take us all the way up to $53. So that's a good run. If we were to hit the 1236 or 1382, it could even extend higher. But look at it, that would be interesting if it actually hit those fib levels and then pulled back into a 4. It is a cup and handle if it fills out that pattern, right? And then we can get some sort of major extension on 5 later this decade, where the price doubles again. So definitely bullish on uranium long term. I mean, there's some good setups here. I'm watching to see if when this 2 gets done, or if it's a confirmed 2, because I know there'll be a pullback. I can get positioned for that pullback after we have a good 5 up, and a corrective, movement down to the support pivot. Then I can get long and ride 3 up.
It's an interesting situation because energy and uranium are 2 sectors that stand out quite strongly as outperforming at the moment, and the sort of interrelationship between precious metals and the commodities ETFs, the commodities indices, is interesting as well, because we saw gold outperforming commodities prior to 2 years ago, and then commodities have outperformed gold for the last couple of years, and now perhaps we're at a turning point where gold is about to start outperforming the commodities sector again. So commodities as a whole and the precious metals are sort of handing the baton from one to the other, but trending, upwards, whilst as I say, energy and uranium have for the last year or more now, a couple of years even, have been outperforming. So it's an interesting setup, and couple that with what we've said about, what you've said about the SPX there, and about general equities, and you can see where the driving force might be coming from for these bullish setups in commodities and precious metals and uranium.
Yep, exactly. So let's see here if I've got, we can kind of see it in individual stocks too. I didn't have CCJ in my report. These substacks only give me so much room to put charts in, so I wanted to kind of hit on the major ones first. But CCJ, right? I mean, Kamiko, it made 5 waves up and then a very long correction. Imagine if you're like, wow, look at that, maybe it's pulling back and then I'm going up. Oh wait, that's just an A wave. Now I've got to wait all the way down, till April, 2020 for it to bottom. But it did bottom. It broke out impulsively, made 5 waves up, and just like the Uranium Trust, we're just waiting for confirmation to whether it was that the 2. For me, I kind of think we need to pull back a little bit more. It needs to complete like this corrective structure before, off to wave 3 we go.
So for the timing, I understand for the smaller ones, the one in the circles, I always look for risk to reward. So when I see the 1 to 2, then of course you could use the smaller fractals, the smaller Elliott wave counts to try to get a timing. But the closer you buy, like that entry, that pullback, the white 2 went up 1 and then 2. That was the generational buy entry right there. That white 2 there, that's back testing that 1 to 2. So back tests of the first correction to those super cycles or the bigger cycles. Those are the generational entries, right? Nobody wants to buy on the pullback to 2. People think it's going back down to the March lows.
Exactly. It's earlier investors. It's these guys that saw the value. They want to take profits, right? And we talked about kind of the Wall Street chart, the sentiment chart. That's your early investors getting out, right? The early profit takers. And it does fool people, and it keeps people from getting in. Most people get in on the 3, like in the heart of the 3 or at the top of 3. right? And then they're like, oh crud, that's everyone else who got in early on 3 is now getting out at 4. Maybe your early investors are also taking some more profits. That's why it causes 4.
Of course, the real answer is to get in anywhere around 1, 2, 3 and just hold on until you get somewhere near your blue 3 and then exit, because it all pales into significance by the time you're up there. But I understand that people wanting to trade on shorter timescales, but there's so much choppiness involved in that whole period from 1 to 5. But the one thing that happens over and over again, as Pat said, is the move to 1 and the pullback to 2. And whenever you see that pullback to the breakout line, that really is, the time to take a position and just hold on for dear life until you get much more, into the mature bull market, as far as I'm concerned.
And that goes what we were talking about with the general markets too, as far as that pullback to 4. What if this goes down below 1? Now I have overlap. This could just be an ABC, and now I am going lower. So that's where you have to adjust your charts and adjust your view, and it helps to know like what's happening on a lower fractal level, and lower degrees. If those were impulsive as well, it tells you you're in an impulsive rally.
And also actually at that point where you got the pullback from 1 to 2, that's where you need to look at, or I think you need to look at something like the ratio chart, and the ratio chart of uranium to the S&P, because that's where your money's coming from. If it's broken out, if the ratio charts are breaking out as well, be it Cameco versus the S&P or Cameco versus inflation, then that's a whole extra layer of evidence that you're going to be heading up from 2 rather than down to some unknown lower point.
Yeah, I was thinking probably at the end of my Substack, maybe do a few ratio charts like that. Just look at different ratios. Right now, I'm just kind of looking at each sector, but that's I'm just starting to getting into different ratios, and I think that there's definitely value in that type of analysis.
I think definitely, when you're taking positions in particularly mining stocks, comparing how those mining stocks are doing to the broader market, what you're doing there is you're spotting the flow of capital from speculative to hard assets, and that tends to happen on a something that happens every 20, 30, 40 years. You get these big cycles that start to get underway, and also versus inflation as well, versus PPI. And I think by doing that, you kind of capture the real key drivers of how these things move versus inflation and versus the stock market. So yeah, I hope you do some more Elliott Wave counts on that, because that'll be fascinating.
Yep, will do. No, it's a lot of fun for me to create these Substacks, and forces me to look at a lot of different charts, and I'm curious too to kind of help build my worldview of things. So definitely want to share this, because I mean, we're going into hard times. I'm pretty convinced of it, and so I think people need to make educated decisions and have their mind open to these types of scenarios, so they can prepare accordingly, so they can position themselves. Or I see the S&P 500 going down potentially this level over these years. That means unemployment could go up. So what if I lose my job? Maybe I need to save more. Maybe I need to not lever up as much on debt. So try to make better choices that way, if not just for investing, like, oh, don't buy this stock or that stock. Just kind of lifestyle type decisions that could help them regardless. If this is all totally wrong, by someone paying off their debt a little bit better is going to be better for them in the long term. So that's why I wanted to share this and give people out there a worldview that I have. So
that's a very honourable thing to do. That's what we're really here for, is to try and shed some light on what can be quite a confusing subject area for a lot of people. And technical analysis and Elliott Wave does often seem like a foreign language to a lot of people. So if we can try and make that a little bit easier to understand for folk, and to be aware of these big changes that are taking place in the financial markets, then hopefully we'll have done a bit of good for people.
Yeah, and it's okay to disagree with other people's counts. I encourage it. If you're on my Substack and you say, I don't look at that, it makes me take a second look. Robert Prechter himself, he has a very bearish count for the S&P 500. He thinks we're going back down to like 1970s levels. I mean, and he's been a bear for years. I mean, I don't agree with him. I think that if we do get a larger bear market, there's going to be some support, that I think, wave fours tend to go back to the previous wave four in the former degree, in the lesser degree. So in that degree, that's the green count. That's the cycle count. That's back to 666, I think. Famous number on this and
Jesus, hell, wow.
I don't think we get there. I think there's going to be some support before that, probably around the 1,000 level. I mean, you see the 236 fib retrace, that's 960.
I think drawdowns of 50 to 60% are fairly typical of the last 3 occasions this has happened. If it goes down more than 60% from the highs, then that's something else, I think. I think that's right. If my memory serves me right from the chart that I did a little while ago, I think 50 to 60% pullback is quite normal. And versus inflation, I think the numbers were more like 70 or 80%.
Yeah, well, what was it during the Depression? That was a huge drop.
Yeah. Measured in gold, all these things they lose about they lose 80 to 90% from peak to wherever it bottoms there 4, 5, 6, 7 years later. It's 80, 90% the dot-com bubble lost. Measuring gold, priced in gold in the 2000
People
dot-com
forget
bubble.
that, and it's not that long ago either, is it? The dot-com bubble. So
90%.
Yeah.
Wow.
Because nominally they could keep that stuff afloat. So, like for your count, yes. Why is there support? Well, they'll start printing money, whatever. They're looking at the nominal price. They don't care about the price in gold SPX. They don't care about destruction of purchasing power. They'll do whatever it takes. Oh, there's support there, and people are just looking at the nominal numbers on the shorter term. They'll pump it up. But then when you price it in gold, that thing is going probably to what's his name, Robert Prechter's levels. It's like then when it's priced in gold, there's no low. Like that stuff could go really low, like it's
kind of scary. Like we're all looking at the yen right now. I'll cover fiat currencies in one of the later parts too, but I drew this a while ago. I said there's going to be a 3. Now it's blowing up. The wave 3 is just crazy, right? So I'm not sure how high 5 is going to go, but yeah, I mean it formed out this triangle. After 5 bullish waves up, then it had some consolidation into a primary 2, and off we go. And it's doing its thing, right? It's
well, I'll tell you what, one thing I like about that chart, I like the fact that it's got arcs on it. So it gets my vote.
Yeah, the arcs are kind of fun. I like because the cup and handle potential, if things are
the arc thing, it's really a way of visualizing Stan Weinstein's stage analysis, and when people talk about Wyckoff accumulations and distributions, the arcs and the domes that you get at the bottom and the top are just another way of representing that. Price can sometimes break below the arc, or you get a false breakdown just like you do with any other support line, but they do. I find that they do give a good rough approximation for where you might be heading a lot of the time.
Yep, and this is compared to dollars, right? So I mean, I'm expecting a wave 4, and it could be a strong one. I mean, we can sink all the way back down to this arc, or I mean, if it's going to stay impulsive, it's got to stay above the 1. But that means dollars are going to be, sold. So
yeah.
Before we get a nominal high, and then another bigger primary wave. We'll see if that arc is valid, for that primary 4 pullback. But then look, this is deflationary here, right? I mean, that means a movement that we just saw strengthen the dollar. So that's why I call it a stagflationary depression, that there's going to be times where all other assets except the dollar are doing fine for a while. Even if inflation is high, like we've seen, people are rushing to dollars because they don't know. It's the cleanest dirty shirt, right? So that time, maybe you do want to have, some savings and be patient with some other assets so you can buy them cheaper relative, because you know what the larger structure is going to do anyway.
Interesting stuff. That's one heck of a chart there, and currencies, of course, have been all over the place, mostly down against the US dollar over the last.
Yeah, I'll show you one more before I go. This one's even scarier. I had a gentleman contact me on. He's watching from Turkey, and so he asked me to.
85% inflation.
He wanted me to track the Turkish lira, and so I'm taking a stab at it. But it's kind of frightening, the way that I kind of see the wave one. It's made its initial wave up, but it's following this like arc type pattern, this larger arc. Again, you can divide it up into 5-wave structures. If I base it off the 1-2 wave, this wave hit right at 3.382, and wave 5 hit at 5.382. Those are accepted Fibonacci levels. So it's starting to make a higher high here, but I also see some divergence. So maybe there's a pullback first for wave 4 before it finishes up here. But that's crazy. The loss of purchasing power in Turkey just against dollars, against lira. I mean, we're talking it going up several times, in a few years, if it completes that wave 5. So it's kind of a frightening chart there. And you wonder if, other currencies are going to follow.
I was going to say maybe it's a peek into the future of a lot of fiat currencies, to be honest.
Well, they all do that, Kevin. All
Yeah,
fiat currencies,
yeah.
US dollar, even the US dollar on itself, it's top left, 1968, all the way down bottom right. And then if you price it in gold, it's even worse. It's really like the half-life is like 4 or 5 years. It's flat. Like they all do that. All do that. It's just different speeds, right? Accelerations.
And we all know why they do that as well. So it's not something that is new.
I would do it if I had if I could devalue stuff to I would definitely do it there. Why? Like, I don't know. It's human nature. They're doing this stuff there. It's like no surprise. They think they would do otherwise and do austerity procedures for years on and cut down government. They've had that in Quebec here. Like I think in the 90s they did austerity and they cut down the government. But Jesus, that was one time I heard about that in my entire lifetime that they ever did that. I'd love to chart government growth, the number of employees in the government or the payroll, Kevin. That would be a great chart to put. The number of times they shrink the government versus increasing it. It's I don't think it happens often.
Well, let's look at one of the big defense contractors, right? That's one of the number austerity. I mean, I work in the aerospace and defense industry. And so, yeah, government spending is crazy for the military industrial complex, right? That's what backs up the dollar. I mean, people think that we still have gold backing up the dollar. They're not educated. No, it's the U.S. military backing up the U.S. dollar, right? Because we've got all the weapons. We can, bring our aircraft carriers around the world and, and show force, right? So we've got to spend for the beast. But yeah, look at the largest defense contractor in the world right now, what it's doing. So I think it's got some time. This tells me that they're gonna, keep, they're gonna kind of keep the beast going for a while, but it's getting ready for a larger Durga correction. So I think is going to be probably an attempt at some austerity at some point. Now this could also be a truncated 5. So I'm watching this carefully. This is just one of my counts. It could be topping with other things. It is slowing down, but I don't see 5 waves done. This was 1, 2. I don't have a 3 and a 4 yet. Now, this 3 could be, excuse me, this 3 could also be here, and then we could be getting a 4 at some point. You see what I'm saying? It's very subjective. I see, the pattern completing here, but very hard to tell where exactly this is going to go. And I've got my fib levels. Where's the 1, 2, 3, 6 and the 1, 3, 8, 2. These levels usually typically where a level 3, or excuse me, a wave 3 ends up being. We almost hit that here, but not quite.
That rising wedge there, is that? I don't know if you're seeing the screen there, Pat. Is that a Livermore accumulation funnel? That rising wedge.
Look, yeah, I don't know. I haven't. I know I want to deep dive the accumulation funnel where it's like a 6 points and it breaks to the.
What I've seen very often is where you get those rising wedges near the top of I suppose you could call it your grand super cycle, or where you get a culmination of a long bullish uptrend. It very often seems to finish with those sort of rising wedges, and you get an upside blowout on the rising wedge. We actually saw it with the gold to silver ratio, Pat, if you remember. The gold silver ratio was putting in that sort of a pattern, and it had, some people refer to it as an overthrow top, and it just blasts out roughly where you've got your blue 3. It would rise up to some ridiculous level above the blue 3 and then come crushing back down in a downside move that would take you down to somewhere I don't know, maybe where your red A is, that kind of area. So you get, it does, it's something that I've, and I think it's, referred to as a Livermore accumulation funnel as well. So, but I think that's more commonly at the start of a move, isn't it? The accumulation funnel, but
Yes.
still,
Yeah.
it's at the bottom, at the bottom of a sort of a bear market where you get that kind of thing sort of triggering an upwards move. But
in Elliott Wave,
regardless,
they call it like an ascending triangle. So which
Okay.
usually end up like this.
they're bearish patterns, but they can fool everybody with a false breakout in the sort of the wrong direction first.
Interesting. Okay.
That's just from classic TA. It kind of wrong foots the market, and you get you spot a bearish wedge or a bullish wedge, and in this case it's a bearish rising wedge, and so you're expecting it to break to the downside, and unexpectedly it breaks to the upside, and then a huge crash down. So yeah, just something to keep in the back of your mind.
But this tells me, we were talking about austerity later, and I also have the looking at the Raytheon Technologies, another big defense contractor, looking at there. I mean, that's like one of the largest expenditures for the United States is defense. So it tells me if there's any attempts at austerity, they're going to look at it all, including defense. So what does that mean geopolitically? As China's rising and they're building up their military? I don't know. I mean, I know a big, depression worldwide is going to hurt everyone, and they're leveraged too. So maybe it's, an equal game there. So they'll have to cut back as well. But interesting times.
I sometimes find myself thinking about fundamentals like that, and then get myself tied in knots, and you find that the fundamentals sort of fall in line with the charts in the end. So the chart
kind of use the charts. It keeps your head straight.
Fundamentals are an interesting sort of thought experiment, but the number of times, for example, when the British pound was plunging a few weeks ago, just looking at the chart, you're able to say, well, this is likely to be the bottom, and the British pound is going to bounce here and start moving up against the dollar. Of course it did, and it's held support. So, and at the time, a whole load of headlines came in, the budgetary problems that caused the pound to crash, they've now been reversed. We've got a new chancellor. He's reversed all the decisions. Well, yeah, of course he has, because the chart told us he was going to do that. So it's crazy how it happens.
Yeah. Well, before we leave, we'll visit silver. I'll cover precious metals in part. Well, just for the rest of the substacks, I'm working on commodities right now, soft commodities and hard commodities. Kind of go through all of that in the next 2 parts, and I'll have to break it up because there's so many charts. So
I know.
And I want to show a lot, and the emails are limited in size, and I don't want to overwhelm people either. But we'll cover precious metals. I'm planning to cover those charts in part 10. But I like silver. I'm kind of tracking it. 2 different counts going right now. I think we could potentially see another nominal low, slightly nominal. It doesn't even have to go down as far as I show it there. Just for another full count reset. It's working 5 waves down, so it is holding up, higher lows. So the less probable is that it's filling like a, like a diagonal type pattern, where it expands, it zigzags, and then moves up. But there's just so much overlap, here. It looks corrective to me, and even this wave right here, it looks corrective. So I think we might get a chance at just one more little whoosh down, and then off to the races we go. So this 618 is from, the highs made off the, silver squeeze day, where it hit a slightly higher high than the August 2020 high. So we'll see what happens. Silver's a wild one, so all over the place.
Good stuff. Well, I hope everyone's enjoyed all that. I certainly have, and I know Pat has. And I think, we just need to say thank you very much, Hypersonic, for coming on and sharing your Elliott Wave expertise with us. Can you remind everybody where they can find you again?
Absolutely. Thank you for having me. It's always enjoyable to speak to you gentlemen. And you can find me on Twitter, Hypersonic78 at Hypersonic. You'll see a link to the Substack. Feel free to sign up for free. I'll try and get one out each week. It's kind of, like I said, my passion. It just depends on work schedules and stuff. But so far I've been able to get 1 email out per week. Just feel free to subscribe to that if you want in your email box, or just check on Twitter. I usually just put it on my Twitter post too, when those new parts come out. You can also search under the Substack, just Hypersonic 78, and then the Substack will come up there. But yeah, I appreciate it, and thanks again for having me on.
Well,
Okay.
we'll try to have you on again because there's so much info, and you know what? Look, we could have just blisted over it, but I think those small details you're giving about Elliott Wave, anyways, I appreciate it, and I think it could demystify a little bit what it's all about, how and why it works. It's not like magic, it's human psychology, it's fractals, and people will be able to use their own trading frameworks and see how that fits with it. It's like never judge a guy's trading framework, judge him if he doesn't follow his trading framework. But
yep,
it's like
and I encourage viewers, if they want to learn on their own, if they go to the very first Substack, under prerequisite understanding in part 1, there's a link there to Elliott Wave Principle, which is Robert Prechter's book. He kind of goes over all the patterns and the structure and the theory of it. There's a quick primer right here, but yeah, definitely go and learn about it and learn about the different structures. And like I said last time, the best way for people to learn is just to start charting themselves. So,
right.
Yep.
Okay, good stuff. Good advice.
All right.
Thanks as always for joining us. And we'll, as Pat says, we'll have you back again in the not too distant future. Good stuff. Thanks again.
Thank you.
Bye, guys.
Bye. Bye-bye for now.